Joining me now for a look at what's driving the local markets is Lavan Gopaul from 28E Capital. Good to see you again, Lavan. It's quite a long time since I have been in the same studio with you, but we said local markets there. In fact, there's an international impetus behind all the markets, which we haven't seen really since the latter part of last year. Everyone's looking to Europe to see what's going on. But let's talk first about ARM, because we had that interview with the chief executive. On a day when the resources led the JSE down by just over 1%, their share price, we saw on the board there with the big losers, 2.3% down. So how should we think about those results?
I think this is in line with what the market expected. Bear in mind the mining companies had been through a tough 2012 period. Also, you had commodity prices that weren't particularly fair for ARM. If you consider the complex nature of their business, it is a number of different commodities that help put together their earnings. So in years where commodity prices are booming, ARM is likely to do very well. I think they were particularly pleased with their results from copper, while some of the other base metals had been an underperformer, and they've had to refocus their exposure to those sectors.
Let's look more broadly at the resources sector in the light of what's been happening in Europe. And I pointed out to Alistair McCaig when we spoke to him earlier in London that the last time we were having these conversations must have been September, October last year. Every morning on the show we seemed to be saying bond yields. That was the big subject of discussion. We haven't talked about that all year so far.
It's become a very important topic. Firstly, you've noticed the Italian elections have ended in a stalemate, and that's created uncertainty within the future of Europe. What investors have done is gauged their uncertainty in Europe by starting to throw away Italian bonds. Yields falling by, in the movement there was almost 50 to 60 basis points. Bear in mind, if the base rate is 4.5 to 5%, that effectively is a 10% change in one day in Italian debt. So it registers as quite a deep scar in terms of Europe being able to sustain itself looking ahead. There's also questions about the cracks within the Eurozone and whether that will be a unified unit. It has a further knock-on effect in terms of the price of the US dollar, the euro, so world currencies, world equities, and world bond markets all rattled by the events yesterday.
We saw the euro-dollar rate down to 130, and it hasn't been like that for several weeks. It's tended to be 132.3 and even up to 35.36. Looking at the other words that come up, contagion, Spain, and also one gets the impression that the markets have been almost willing the Eurozone crisis to go away, not been talking about it, but it's still there, and it doesn't take much to remind us.
It takes a very small event like the Italian elections to highlight the fact that at this stage, the problems still exist in Europe. They aren't able to settle their immediate commitments, and it is a case of kicking the can down the road. For now, it would seem that, as you mentioned, the yields on the Italian bonds have signaled a sell-off again in Greek debt. Spanish debt doesn't look so interesting, and at the same time, you're finding other parts of Europe, their debt market looking a little shaky. So German bond yields not looking very good, and London gilts also under a bit of scrutiny. 130, as you mentioned, on the euro against the dollar. Well, that's a very important level. It's a key technical / psychological bounce level. But if it is able to break that level, obviously there's going to be a chase down to 127.
Let's look at the effect of the Eurozone issues that you just discussed with our market.
What we've noticed is we've just taken direction from Asia and the futures indication from Europe, and our market opened at a very deep red level, almost 300 points off on the local bourse. The immediate losers were big industrial shares, Naspers, as you mentioned in your earlier slot. MTN also marked down a number of big industrial companies like Bidvest. It was almost as though investors were happy to take their vengeance out on industrials and marking our JSE down by at least 300 points near the open.
Yeah. What do you expect to happen, given what has happened before in the Eurozone? Then everyone gets obsessed with these debt yields and the fragility of the politics. What are you expecting for our market?
For now, it would seem that our market's been buoyed by good earnings. At the end of the day, companies have been able to deliver strong earnings, and that's kept this market in check. while a few companies have got unrealistic price to earnings ratio, in general, the ratios that you're seeing by companies are fairly decent. They've met analysts' expectations, and these are profitable businesses. We will unfortunately take the cue from what happens in world markets. You're likely to see economic data from the US. If it comes through at a fairly reasonable level or at a plus point, you're likely to see that turn markets into the positive. For now, it would seem world markets have run very hard and have run fast, and there's a lot of profit taking across the board.
Right, I want to get onto the budget in a moment, and I want to get onto the GDP number, which for a change was a surprise on the upside for most commentators. But let's just look at the banking sector. We had Nedbank coming out a day or two ago. We had a FirstRand trading update which looked as good as its previous one, over 20% headline earnings up, as Nedbank was. The banking sector is running well.
It is. You've had a very favorable legal lattice, and from that, the banking shares have been able to grow quite steadily. Obviously, their bad debt ratio has been kept in check. A formula that a number of analysts will remind you about is the fact that in a low interest rate environment, banks seem to do very well. Bear in mind their markup is just a function of the prime lending rate. So it's a phenomenal percentage return for them.
I want to talk also about, there was a column by Stuart Theobald in Business Day earlier this week. He talked about the African bank issue and the national credit regulator, which some market commentators are saying was going a bit wild in recommending this 300 million rand fine for an event which they seem to think was reckless lending, but in fact was a fraud which the bank dealt with. So perceptions of the regulator not offering the kind of certainty that relationships with the Reserve Bank offer.
There are three different shadows that they're trying to hide under. Firstly, the fact that you've had all of the strike action last year linked to bad lending, and that fast and loose lending, they had to find a scapegoat, and it would seem that Abel was just in the wrong place at the right time. The other fact is that a number of money lenders have just been accused from a variety of moral accusations. They've lent money to Joe Public, and the very important point is that they are there to show the rest of the country that they're doing a good job and they're making an example of Abel.
Also, one gets the impression that a lot of the lenders that are causing the trouble in mining communities are not the Capiteks and Abels of the world. There are a whole lot of other guys out there who are lending money in ways that they shouldn't. But what about the budget and the effect on things like the rand and interest rates?
In terms of the budget, the first question will be how government aims to pay for NDP. Whilst that is a very wonderful gesture and a number of interesting points, there's the general thinking that we can't afford it at this stage. Certainly it'll be a deficit budget. Very interesting points that are on our wish list. For example, do you get any relief if you pay for your own security? If you pay for your own private education or healthcare?
That's not going to happen.
It won't happen. Securities taxes is another question, where the derivatives will be added on.
Well, also the point is, I mean, this is, and I mentioned it earlier to Arthur in Cape Town, is that the legitimacy of the budget perhaps a little bit under question, because you could, if you calculate all the taxes you pay plus all the things that you pay for in a private way, which the state is supposed to provide for many people, you're looking at 2/3 of your income.
There is a fair amount, a big whack that goes off to taxes, and as you correctly point out, all of these services that you expect government to pay for, you still have to pick up the tab. Whilst we have that massive problem, balancing the fiscus is still going to be a weighty issue. And tomorrow's budget, a number of investors will look out for whether there's going to be any bracket changes. There's still an expectation of a Robin Hood tax, so the wealthy are expected to be paying more taxes. As you mentioned earlier on, sin taxes going to be high on the agenda, and it dovetails with healthcare spending. But in general, I think it's a budget that is probably going to be on the deficit side, and the big question is any impacts on the rand because of the NDP spend, or if it's a deeper deficit than what the calculations sit at, you're likely to see that impact the rand as well.